So today we're going to talk about why the Federal Reserve is cutting rates and how you can take advantage of them doing so. On September 17th, 2025, the Federal Reserve reduced the federal funds rate by 0.25%. If you use savings accounts or money market funds, you have likely already received a notice explaining that your rate has been reduced. This is because these vehicles invest in short-term securities that adjust with the federal funds rate. And being that my team expects the Fed to cut rates 2 more times this year and possibly even 5 times by May, you can expect more saving rate cuts. Let's quickly touch on why the Fed is cutting rates. The Federal Reserve, while mainly responsible for price stability or inflation control, also actively uses their tools to manage maximum employment and financial stability. Having seen a weakening jobs market as well as inflation pressures easing, according to the Bureau of Labor Statistics data, the Federal Reserve is attempting to reduce the extent of their tightening on the economy. Historically, this time period coincides with recessionary pressures, which requires a loosening of credit conditions to spur economic growth. Now that this is understood, let's focus on how to lock in higher rates for longer. These are options that we are currently using for our clients. If you're looking to keep higher rates for a shorter time period, such as 6 months to a year, you can buy fixed income securities such as Treasury bills. For example, if you plan to buy a house in 1 year, you can buy a Treasury bill that matures in 1 year. Even if rates fall between now and maturity, your rate does not change. Now, if you're looking for potential gains in longer-term investment opportunities, longer maturity fixed income securities is an area you can partake in. Remember, just because the federal fund rate falls does not necessarily mean that the longer-term rates will also fall. Bond pricing is inversely related to interest rates. Historically, when the Fed enters easing mode, the economy is entering the recessionary part of the cycle. In this part of the cycle, longer-term notes and bonds tend to see interest rates fall and prices increase. And remember, if you were to keep these securities until maturity, your interest rates are locked in. If you are interested in seeing how we can help you lock in rates or how the business cycle can affect equities, let us know. Thanks for your time.